The foundation of a thriving economy is tax revenue. Tax revenue is the lifeblood of any nation. It fuels essential public services like healthcare, education, and infrastructure. Without a steady stream of tax revenue, governments struggle to provide for their citizens, leading to economic instability and social unrest. A robust tax system ensures fairness and shared responsibility, with everyone contributing their fair share to support the common good. When individuals and corporations evade their tax obligations, it undermines the very fabric of society, creating an uneven playing field and hindering economic growth. Governments rely on tax revenue to invest in projects that benefit society as a whole, such as building roads, bridges, and schools. These investments create jobs, stimulate economic activity, and improve the overall quality of life for citizens. A well-maintained infrastructure is essential for businesses to thrive and for people to connect with each other and access essential services. Moreover, tax revenue allows governments to provide a safety net for the most vulnerable members of society, ensuring that everyone has access to basic necessities like food, shelter, and healthcare. A fair and efficient tax system is crucial for maintaining public trust in government and fostering economic prosperity. When individuals and corporations believe that the tax system is rigged against them, they are less likely to comply with tax laws. This can lead to a vicious cycle of tax avoidance and erosion of the tax base, further straining government finances and undermining public services. Therefore, it is essential for governments to continuously adapt and strengthen their tax systems to keep pace with the evolving economic landscape and ensure a level playing field for all. The digital age dilemma: new avenues for tax avoidance. The digital revolution has brought about unprecedented opportunities for economic growth and innovation. However, it has also created new challenges for tax authorities worldwide. The rise of e-commerce, digital currencies, and online platforms has made it easier than ever for individuals and corporations to shift profits to low-tax jurisdictions and minimize their tax liabilities. This digitalization of finance has made traditional methods of tax enforcement less effective, requiring new tools and strategies to ensure a fair and equitable tax system. The borderless nature of the Internet allows businesses to operate in multiple jurisdictions simultaneously, making it difficult for tax authorities to track their activities and profits. This is particularly true for multinational corporations that can easily shift profits to subsidiaries in low-tax countries through complex accounting techniques and transfer pricing arrangements. Additionally, the anonymity afforded by digital currencies and online platforms provides further opportunities for tax evasion and avoidance. The ease with which funds can be transferred electronically across borders makes it challenging for tax authorities to monitor and trace financial flows. This has led to a surge in cross-border tax avoidance schemes, where individuals and corporations exploit loopholes in different tax systems to minimize their overall tax burden. The lack of coordination and information sharing between tax authorities in different countries further exacerbates this issue, allowing sophisticated tax avoiders to slip through the cracks. Unmasking the illusion, revenue reclassification, and the erosion of taxable income. One particularly insidious method of tax avoidance employed in the digital age is revenue reclassification. This tactic involves manipulating accounting entries to make revenue appear as if it were generated in a low-tax jurisdiction, even if the actual economic activity took place elsewhere. This effectively reduces the amount of taxable income reported in high-tax countries, leading to significant revenue losses for governments and an uneven playing field for businesses that operate transparently. Revenue reclassification can take many forms, but it often involves exploiting differences in tax laws and accounting standards between countries. For instance, a company might artificially inflate the revenue of a subsidiary located in a tax haven by attributing a disproportionate share of profits to intellectual property rights held in that jurisdiction. Similarly, a company could manipulate transfer pricing arrangements to shift profits from high-tax countries to low-tax countries, thereby reducing its overall tax liability. The rise of digital platforms has further facilitated revenue reclassification. For example, online marketplaces can act as intermediaries between buyers and sellers located in different countries, making it difficult for tax authorities to determine where the value is created and where taxes should be paid. This opacity in the digital economy allows some companies to avoid paying their fair share of taxes, while others that operate transparently are put at a competitive disadvantage. A new era of tax transparency introducing the tax accounting equation. To combat the growing problem of revenue reclassification and other forms of digital tax avoidance, tax authorities need new tools and strategies that can effectively pierce the veil of complex corporate structures and online transactions. This is where the tax accounting equation, or TAE, comes in. The TAE is a novel approach to tax enforcement that focuses on analyzing a company's global financial transactions to identify discrepancies and red flags that may indicate tax avoidance.